Okay, in part two of our discussion of capital structure and financial distress, let's continue talking about some costs, and then ultimately we'll get to talk about how this ultimately affects the value of the company. So the next set of costs are these indirect costs. Well, the indirect costs they're difficult to measure. They're going to be ultimately as an accumulation, since there seems to be a lot more of them here than we talked about with direct costs. There's just more of them, and these costs could be ultimately much higher, much greater to the company than the other costs, right? You're going to possibly lose some customers or some suppliers. You may lose some of your employees. In fact, you may lose some of your better employees. So all of these costs are very difficult to measure, but they're absolutely there. You know that they're there. It's just how do we ultimately measure them? So the estimate of cost here is that the potential decrease in value from these indirect costs is 10 to 20% of the firm's value. So the total cost of bankruptcy can be anywhere from 13% to 24% of the entire market value of the company. This is huge, right? So we have to be concerned. We have to, number one, go into bankruptcy slowly. We have to think about it and be very conscientious about the decisions we make. But we also have to understand measuring the cost is going to be rather difficult. So we have to look at a couple things. What is the loss to the total firm value? We have to figure out what that is, because it's not just losses to equity holders and debt holders, but it also talks about any transfers before them. So there are changes in the value of the company for all the players in the capital structure. Any of these incremental losses, right, they're going to be that are associated with this distress are above and beyond any other losses that you're going to incur because the business is in trouble. So this is the 24% maximum that they talked about. That is just the cost of bankruptcy. Well, why are we in bankruptcy? We're in bankruptcy because we're losing value. We're losing control of our business. So this 24% is in addition to the loss in value from the actual challenges of the companies. So back to our company, right? If this new product fails, the equity holders are going to lose, right? And they're going to lose, but they're not going to care about bankruptcy costs because they are the equity holders, right? The debt holders recognize that if this thing fails, they're not going to be able to get their full value, right? So the shareholders really don't care that much about the bankruptcy costs. The ones that care about the bankruptcy costs is really the debt holders, right? The creditors are the ones that are very concerned about these bankruptcy costs. So how is this going to affect getting money? Well, debt holders are not going to be willing to pay as much for the debt of the company. They're going to want to get a higher rate of return. So the total cost of financing, the total cost of financial distress is going to increase because creditors are going to want paid a higher rate of return. And in the end, all costs are going to go up because the company ultimately is riskier. When securities are fairly priced, the original shareholders of a company pay the present value of these costs of bankruptcy and financial distress because they're trying to get funding and they have to pay more money to get the funding because the cost, the price that the creditors are willing to pay is lower because they want a higher return because there's now the company is ultimately riskier. So what this brings us to is something referred to as the trade-off theory. It says, look, a company is going to pick its capital structure on the basis of the benefits it gets from its tax shield, but those benefits are offset by the cost of financial distress. So our formula, again, looks like this. The value of a company with debt, V sub L, levered company, is the value of an unlevered company plus the tax shield the company receives minus the present value of financial distress costs. So again, we've incorporated this concept that we started with Modigliani and Miller, that as we go through this process, we've lightened up the assumptions of our discussion, and in that process, we have added, in this case, we've added a detriment to value rather than a benefit to value when a company borrows funds. Now, what we find is that this number, this present value of the interest of the tax shield, is kind of a fixed number, right? Or it's a variable that it creates the line with that slope. It doesn't change. For every dollar you borrow, there's an increase in wealth based on T sub C or whatever the tax shield is. However, when a company has very little debt, the present value of financial distress is very low. So at very low debt levels, this negative impact, this negative effect of borrowing is very small. So the V sub L will go up above the V sub U, but it will be offset a little bit. When a company gets more and more debt, this number, this calculation stays the same. However, this number is going to grow. So ultimately, the trade-off is there is a point when the present value of the tax shield is now less than the present value of financial distress. So what are the factors that we have to think about with these financial distress costs? First of all, we have to think about what is the probability of financial distress. This obviously increases with the increase in the amount of debt that the company has, right? It increases with the volatility of the firm's cash flows. So as companies borrow more and more money, the probability of financial distress goes up. But also, as the company becomes more volatile, or when companies are more volatile, that also has an impact on increasing the probability that the company will see some financial distress. The magnitude of the costs is really dependent on the industry. Technology firms will have high financial distress costs because of the loss of customers, key personnel, as well as the fact that they have very little in the way of tangible assets. But any company that has a great amount of capital, the cost of financial distress will be offset because you could always sell assets to pay off debt. If you ultimately really needed to, you could do that. So the appropriate discount rate, then, we need to understand what is the cost of financing when we recognize, or when we see this, when we include the concept, if you will, of financial distress, right? So obviously when the costs of a company are high, when the company does poorly, the beta of distress costs has an opposite sign. So if there is a systematic risk in the distress costs themselves, that is going to have a negative sign. So the higher the firm's beta, the more negative the beta of its distress costs will be. And again, I think that should be sort of intuitive, right? That in the end, the higher the systematic risk of the company, the higher the risk of distress is, but since distress has a negative connotation to value, it will have a negative sign to it. So, what is the optimal leverage? How much debt should the company have? So for low levels of debt, the risk of default is low. The main effect of an increase in leverage is an increase in this tax shield. And as I mentioned, as the level of debt increases, the probability of default increases. So the probability of future financial distress increases. The trade-off theory says that we should increase leverage until we get to the point where firm value is maximized. And since we have these aspects, one of them is positive and one is negative, we can employ an economic concept called marginal cost. When the marginal costs equals the marginal revenue, we would have a zero profit economic event. And at that point, the value of the company should be maximized. So this trade-off model can help us explain some things. It might explain why companies choose debt levels that are lower than the interest tax shield would imply. Differences in the use of leverage across industries, right, also make some sense now, since we now know that with different levels of capital assets, etc., we can find different industries may have different sensitivities, different volatilities, varying amounts of uncertainty that's going to affect how managers decide to borrow. So in the end, we end up with not that line that we had talked about before, but we now have a curvilinear structure. And this curvilinear structure is the value of the company. And again, following our formula, I think this might become a little bit more intuitive now that we see the picture. It's a little more intuitive. As the company begins to borrow, the present value of financial distress is less than the tax shield, so there's an increase in value. But there becomes a point where that increase in present value of financial stress eats away at the benefits that are gained. So at some point there is an optimal amount of debt for the company. So in this instance, the trade-off value implies that there is a place where the company will have its optimal amount of leverage, right? At that point, they would be maximizing the value of the company. Now, if we could put a formula to this graph, right? We have a curvilinear function. We could apply some calculus techniques and we could calculate that maximum point. The challenge is this curve is created by the costs of securities, which is impacted by obviously the returns of securities, and those are impacted by prices, and prices change all the time. In addition, the weights that we've been talking about with respect to the capital structure are market value weights that are again tied to the marketplace and prices changing. So even if we had a formula, the moment you calculate the formula, the value is going to change because it's influenced by the investment world and prices. So we're going to continue this with a third video to try to explain a little bit more about how managers may ultimately employ the concepts of borrowing. How are managers going to make this decision?